Sean McCracken from Hotel News Now here with Mitt Shah, Noble Investment Group. And Mitt, what's new and interesting in the world of Noble right now?
Well, Sean, first of all, it's great to see you here in New York, and I think what's new and interesting right now in our space. I mean, you saw another announcement this morning from our friends at Marriott. Is the growth of this mid-scale extended stay space that is not new. It's been in our sector for quite some time. And you've had a few of the brands that have participated in, but just most recently, you've had Hyatt make an announcement, you've had Hilton make an announcement, and now Marriott make an announcement. So you could ask yourself, why is all of that happening? And I think it's, really the trends of how consumers are thinking about how they stay and how they live. And, this product type, let's not mistake it with, some of the top tier upscale extended stay brands like Residence Inn and Homewood Suites and, Hyatt House. But these are types of hotels that really do cater to the widest swath of travelers and those that live for longer than 30 days. And so, I think the first thing that conjures up is like, wow, this is really coming close to kind of a nexus between hospitality and multifamily. Yeah. And I think that is, something that's really, really good for our business because at our core, we are serving, people with experiences in our hotels. And as they get, accustomed to those kinds of experiences and how that feels, it makes sense to kind of start migrating towards longer stays, more apartment-like type offerings. And so for us, we are going to be making a continued significant investment in this space. And a couple of things just from an economic standpoint that I think are really interesting. I started this business 30 years ago. And we were building Hampton Inns at the time, and U.S. RevPAR in 1993 was $40. You build a Hampton Inn for $40,000 a room. Just like it's actually coincidental that those two numbers mapped on top. But
made the math simple, though, right?
It made it very simple. So if you could find a market that had $40 RevPAR, you could build it for $40,000 a room. Your continental breakfast costs were 27 cents an occupied room. You could build these for $75 a square foot. Essentially, you could generate 50% profit margins in the first 12 to 18 months of an operation. It was a beautiful business, very simple. It's become more complicated over the years, for sure. But this product type is actually also further interesting. This mid-scale extended stay. For a couple of reasons. One is that from a cost to build standpoint, even though construction costs are, $230, $40 a square foot, we believe that we can build these with land for $130,000 to $140,000 a key. We believe we can generate $90-ish RevPARs in these assets. And because we believe that we can run them with, circa 7 to 8 full-time employees, which now that conjures up this whole nexus between multifamily and hospitality, right? Because of the few amount of FTEs, you can start really generating those same kinds of profit margins. So when we think about like what are we really excited about, I think first and foremost we're super excited about the future of travel and hospitality. We're seeing it obviously in all of our numbers across the world. But we're also very, very excited about this product entering the market and being a large player in that.
Yeah, I mean, and it seems like in the last few years that space has been so much more on the table for, the institutional investment types who, I mean, I don't even know what a REIT quality asset is anymore. Like it seems like the world of potential hotel investments has kind of opened up, and that kind of mid-market, lower-end segment stuff is more on the table for a lot more people because they see how compelling it is as an investment.
I think you're exactly right, Sean. Think about back to 97, 98, and I know I'm dating myself here, but what you started to see were real estate investment trusts come in that were focused on select service and extended stay. Remember all the names, right? It was Equity Inns, it was RFS, it was Winston Hotels, and Jeff Fisher with Innkeepers. Like all of those kind of came about, and that allowed the public markets to really understand this asset class from a performance standpoint and institutionalize what is today in select services and say very institutionalized, right?
Yeah.
You know, it's REITs, large PE firms and the like. Well, in this segment, you've had two of our largest, private equity firms in Blackstone, who's bought Extended Stay America 3 times, and you've got Starwood Capital with In-Town Suites that own that now in permanent capital vehicle, that have also institutionalized this asset class, and Brookfield own over 100 Wood Springs, and like so. I think what's I kind of started this like this is not new.
Yeah.
What is new is that you have, Hyatt, Hilton, Marriott, all now thinking about their, organizations in a world where this is a product where people will live for, 30 plus nights.
Yeah.
That is different. I mean, it'd surprise you if you actually looked at the average length of stay of Residence Inn, Homewood Suites, Home 2, Town Place, et cetera. It's not very long. In terms of those actual amount of days, because the transient demand is so high and they like that suite offering. But the magic really happens in these kinds of longer term apartment type stays where you have these really long 30-day, 30-night stays. Now let's also level set this. If you charge anywhere between $80 to $90 a night for this, and on a 30-night stay, that $2,500 to $2,700 that you would pay, fully furnished, no security deposit, TV, all your utilities and the like. And so if you think about the workforce housing that really exists out there, that will continue to exist with infrastructure, with traveling, medical professionals and the like, I think this is why there's a lot of excitement around what that's going to look like. Hence, our excitement in terms of being a large participant.
Yeah, I'm curious whether you think the brands move in more concertedly into that space. Excuse me. Is also a sign that maybe they'll be in more direct competition with, alternative lodging like the Airbnbs of the world and the kind of serviced apartments. Like that space already exists. I'm wondering how that you kind of see all that shaking out.
Yeah, I do believe that everyone is thinking about their own brand relative to how they capture customer loyalty, and how that you can drive that through other types of channels that you might not have, right? It's been a sole vertical. It's been hotel stays, hotel stays, hotel stays. And then you've had some that say, hey, we're going to build, residences on the luxury side, right? And that feels comfort. You've seen Marriott get into the cruise space in terms of, the luxury cruise lines and the like. So I think it's a natural evolution for them in terms of how they think about that customer that has grown accustomed to, what that offering is, the consistency of that offering, and as people get older, they're looking for reliability, I think, and, quality and reliability. And, Marriott, announced Apartments by Bonvoy. That's not new. They have a big service apartment business. Wouldn't surprise us to see others, think about that space as well. And is that is that competition to Airbnb, or is it simply providing those customers an offering through a platform that they have a lot of trust in, so that they can, for whatever their travel needs are, they can, be fulfilled.
Mm-hmm. So, back to the point we were making earlier about kind of the select service space being more investable. Obviously, you guys did a big deal last year with Host, which, obviously a huge, the biggest hotel REIT. Like, how did that deal come together, and what do you think that says about what Noble has been doing the past few years?
So what I would say about that is, first of all, they are incredible friends and partners. And, as we fast forward, 15, 16 months from, when that deal was announced, it's even better than we could have imagined, because what we get a chance to do is to envision what does the future of travel and hospitality and leisure look like? And through their platform and all the data that they've got, through our strategies and what we have. And so they're a large investor in our current real estate fund that's approaching $1 billion of equity. And their whole goal is to take capital from their balance sheet and invest it in private strategies through the Noble platform. So that was the genesis of all of this. And I think where we are, today, and going back to some of these things that we talked about with this mid-scale extended stay, or other types of adjacencies to our core business. That's what's really, I think, exciting for us, because if you again just look at the data. In 2030, we're going to have 40 million more people that are aged 55 to 79 and 25 to 39. Right? Those are the two largest traveling demographics. 40 million more of them. We know that what locational flexibility means, right? And we don't need it to do that because the data shows that. But the other thing that we're really seeing, and Tony Capuano was on Squawk Box, saying the exact same thing, is that like consumer spend to experiences and travel is growing at the highest pace that it has been over durable goods. And so when you put all of those together, the future of travel and hospitality is really exciting. Now, our responsibility is to think about what is that. And just like we're sitting here 30, years, after we started, our business, and 30 years prior to, there wasn't select service. It was, big, large, full service types assets. And 30 years before that, there wasn't anything, right, before the interstate system. So as you fast forward, each of these kinds of decades and years, the innovation, how consumers really look for products and ideas. I think what we believe is that we're at the forefront of something that is going to be continued, growth for our sector and product types that we can invest in, that may not look like the things that we've done in times past.
So obviously optimism for the long term. Are you feeling as optimistic in the short term with, looming recession or whatever that might look like? How are you feeling about, the rest of the year, next year? Like, what do you think we're going to see?
Yeah, it's a great question, Sean. I think you can pick up the paper or watch the news and get a variety of different, types of reports and feedback on all that. I've stopped predicting what we think that is going to, to look like. And I think, because you just can't be right.
Yeah, we had a lot of people make really terrible predictions in early 2020.
And so I think fundamentally that's why I started with the long term, and then you sensitize what the near term is. And so our business in select service extended stay, it's an 8-cap business, right? So it's very easy in which to understand. You buy at 8% yields. You turn them into 10% yields through, operations and renovations and the like, and then you go sell them at 8% yields, right? It's really a very easy business in which to kind of do the math around. If you take that 8% business and you have a 5% reduction in RevPAR, and by the way, at 8% you still have positive leverage, right? So an 8 unlevered can be a 10 leverage yield. You're still making, a very strong high single-digit return. If you feel like it's going to be a 10% reduction in RevPAR, and forget about for how long, etc., then that number, starts to look like a 6, right? Okay. If you think it's as bad as the GFC, you're still at circa 5. In terms of RevPAR, like we proved through the pandemic, and I'll give credit to Dan Hansen, who was the CEO of Summit at that time. Like he did the math, and we were talking on a very regular basis that at $100 average daily rate and 50% occupancy, you could break even, right? So it's a business that can take a lot of hits and still keep going. Yeah. Right, and so not to be Pollyanna about it, but the reality is that nobody knows.
Yeah.
But if you believe in the long term and you know the supply growth is really going to be de minimis across the scale. Now, I just talked about building a bunch of the mid-scale extended stay, but just in general, then, you know, you know that you can take some hits. And again, a lot of that is, you know, we leverage our assets, you know, closer to 1-to-1 leverage, you know, just, you know, be, you know, very prudent and all of that. It's a good business. And so I'm not as concerned about what that looks like over the next 6, 12, 18 months. If you ask me, submit, you can't, you know, you can't be Switzerland here. You got to pick, you know, do you think it's going to be, you know, this or that? I actually am more of a bull in terms of what the next 12 months look like. I think the next 6 months probably moderates more. But the following 6 months, you know, is likely more to outperform.
Yeah. And I mean, you're right. You never know. It feels like I look back to 2019 at NYU and Alice early in 2020. If the feeling, the tone I got back then was everybody was kind of half-heartedly rooting for a recession, right? Because they just wanted to peel the Band-Aid. Like it felt like everything had plateaued, so they wanted the cycle to crash, so start a new one. And then look at what everybody got. So I mean, there's no point predicting, and there's no point like saying it's going to go this way or that way, right? Like as long as it's a strong business.
You're exactly right, Sean. I actually think you and I spoke in 2019, and I think the conversation was like, how, you know, how do you feel kind of mid part of the year? And you know, one of the concerns we're having is that we knew RevPAR growth was flatlining, right? And but costs continued to increase,
for sure.
And we had to take costs out of the system. Like it did, it made no sense, you know, for that to run the way that it was running. And so nobody was hoping or predicting, you know, I think for what we saw next. But from that time frame that we talked about, and this is actually interesting to note. I believe that the brands became very thoughtful around how to really think about the cost structure of this business. And so a lot of work started, you know, was in place and was happening. It's the reason why I mention it, because we were knee deep in a lot of conversations about how to use technology and innovation to take costs out of the system. And so when the pandemic hit, we were prepared to kind of, you know, pull that Band-Aid off, make some structure changes because you could.
Yeah.
And so now, while, you know, some costs have kind of entered back into certain things, like the amount of, you know, times that you know, housekeeping is done and the check-in experience and, you know, some of the food and beverage deliveries, those have changed. And those are having, especially in the select service space, and those are having a meaningful impact, especially when you've seen the kind of rate growth that we've seen.
Yeah, I'm wondering, how do you feel about where we're at and kind of digesting that shift? Because obviously there was, you know, the pandemic scaled back service exponentially further than anyone expected that it would have so quickly. And then, you know, guests came back probably more quickly than people expected. So there's this kind of push and pull between how much can you cut, what do guests forgive. We're a couple years removed from that now. Where do you think we found an equilibrium? Maybe is that move into mid-scale extended stay an answer to find a product that you don't have to, the expectations are a little lower and you can staff it a little more reasonably?
Yeah, I believe the answer to your question lies on, it depends on where you're at, the kind of product that you're at, what are you charging, and what do you need to deliver for based on what you're charging, right? And I think that's actually just been fundamental to you know, our industry for a very long time. You know, the more that you charge, the more you know what people deserve. You know, we're having these conversations. You know, I think earlier this year about just what happened with luxury last year, right? I mean, you went from, you know, $500 a night to $1,000 a night overnight, you know, just in terms of that. And so what services do you need to deliver when you're charging that much, or $2,000 a night? And so I think that's one part of it. The other is, you know, in the select service extended stay space, it's what is the consistency of the housekeeping or the food and beverage projects, et cetera. There's just not as many costs that you can kind of add back. I do think the housekeeping is a portion is sticky, right? Like it makes total sense, you know, not to be in the room every single day. to be able to to have clean towels and to be able to tuck in your bed. But there's I think there's a natural acceptance to that, which is meaningful, right?
Yeah.
And I also believe there's a natural acceptance to utilizing more technology. And even though I don't think the take rate on automated check-in is as high as it needs to be, as occupancy continues to grow, people will opt out. I mean, when we started using that at the airports, it wasn't because we didn't want to talk to anybody. It was just easier for us to go check in and get those plane tickets that way. So I think so that's one part of it. The other part of it is, and you got this exactly right. What's really, really exciting about this Midscale extended stay is we're talking about 6 to 8 full-time employees.
Yeah.
When we're not talking about like, breakfasts and all these other amenities that we added back into the business. And early in the conversation, I said, when we started this 30 years ago, it was 27 cents an occupied room for a continental breakfast. You had some bananas and you had some granola and you had some oatmeal, and it was pretty simple. And you didn't go rogue and go buy, cranberry juice, right? Because that wasn't the brand standard. And people learned to accept that that's what you got at that price point. Now, as we increased the price points, we started offering more and more and more and more and more and more. And that's like in any other business, in any other service business. If you feel like you can get more rate and you can drive more preference, you're gonna, offer more things.
All right. So one last question for you, and I know you were saying that you don't like to predict the near-term future, but who's going to win the NBA Finals?
Well, I've thought that Denver was the best team all year. They're so talented, and it's really it's really hard to stop Jokic. But Miami, they represent everything that we love about sports, and they're gritty, they're tough, so I wouldn't count them out. I do think Denver wins this series, but I think it's going to be a heck of a series.
All right. Well, thanks so much, Mitch. I appreciate you taking the time.
Thanks, Sean. It's always a pleasure.